Welcome to the Skilled MBA Finance Case Study Series, where we explore real-world ventures that embody financial innovation, strategic thinking, and long-term value creation. Research Affiliates stands at the forefront of quantitative investing with its dynamic multi-factor strategies, an approach designed to optimize portfolio performance by intelligently allocating across proven investment factors. Rather than relying on static exposure, the firm dynamically adjusts allocations to factors such as value, quality, momentum, size, and low volatility. The goal: to systematically capture risk premiums while managing downside risk and improving long-term risk-adjusted returns. Grounded in decades of academic research, this strategy bridges theory and practice, applying empirical insights to evolve beyond traditional models like the CAPM or single-factor approaches. It emphasizes diversification not just across assets, but across sources of return. This case provides a window into modern portfolio management, where adaptability, data-driven insights, and disciplined rebalancing offer a competitive edge. It underscores how innovation in financial science can lead to practical tools for real-world investors. Factor investing targets systematic risk and return sources, capturing long-term risk premiums beyond market cap indices. Key factors include value, focusing on underpriced securities; quality, emphasizing strong fundamentals; momentum, targeting positive price trends; size, favoring smaller growth companies; and low volatility, selecting stocks with lower price fluctuations. These factors explain returns beyond mere market exposure. Research Affiliates, a leader in smart beta and factor-based investing, developed the RAFI Dynamic Multifactor United States Index. This innovative strategy dynamically adjusts factor weights based on relative valuations, aiming to exploit cyclical mispricing by buying undervalued factors and reducing exposure to overvalued ones, potentially enhancing risk-adjusted returns over traditional methods. Research Affiliates identifies cyclical mispricing in markets, suggesting active management of factor exposures can generate alpha. Factor premiums are cyclical, with periods of underperformance and recovery, similar to value and growth cycles. This dynamic approach combines passive investing with active management, using systematic rules to adjust factor exposures instead of discretionary security selection. The dynamic factor methodology involves assessing each factor's valuation against historical norms using proprietary metrics. By comparing valuation signals across 5 factors, relative opportunities are identified. Optimal factor tilts are determined based on these metrics and conviction signals, leading to portfolio rebalancing. This process ensures weight adjustments are made periodically, effectively managing turnover. The performance evaluation framework involves comparing benchmarks like the Russell 1000 Index, single-factor, and equal-weight multi-factor portfolios. Key metrics include absolute returns, volatility, Sharpe information ratios, and maximum drawdown. Factor attribution analysis helps determine if factor timing adds value or just noise to the investment process. The cyclical nature of factor performance is evident in value, momentum, and quality factors. Each exhibits distinct return patterns across market cycles, highlighting the potential benefits of dynamic allocation. Understanding these patterns is crucial for optimizing portfolio strategies and enhancing returns. Implementation challenges in factor investing include data mining concerns, risking overfitting models to historical patterns. Transaction costs from dynamic rebalancing can erode returns, especially in less liquid markets. Precise timing is crucial, introducing execution risk and behavioral biases. Additionally, client expectations can lead to redemptions during underperformance, testing investor patience. The RAFI Dynamic Multifactor United States Index exemplifies Research Affiliates' factor timing theory. It employs proprietary valuation metrics to evaluate factors against historical norms, smooths signals to reduce noise, and controls factor exposure tilting to manage risk. Turnover constraints are applied to limit costs, ensuring dynamic adjustments maintain diversification across core factors. Behavioral finance highlights investor overreaction to short-term news, causing temporary factor mispricing. This, coupled with return chasing, leads to factor crowding and eventual reversals. Dynamic factor strategies demand contrarian discipline, investing against market sentiment. However, time horizon mismatches pose challenges, as factor cycles often outlast investor patience, complicating implementation for institutional managers. Research by Asnis, Ilmanen, et al. 2017 suggests value spreads can predict future factor returns, while Arnott, Beck et al. 2016 highlight mean reversion post-valuation extremes. However, Dimensional Fund advisors and Vanguard caution against the reliability and cost-effectiveness of factor timing, indicating practical challenges despite theoretical support. In portfolio management, students construct and evaluate factor portfolios using modern portfolio theory and performance attribution. Investment strategy discussions cover passive to dynamic allocation models. Behavioral finance explores psychological biases, creating factor premiums, and challenges in contrarian strategies. Real-world implementation examines transaction costs, client communication, and governance challenges, bridging theory and practice. Evaluating dynamic multi-factor strategies requires comparing their success to simpler alternatives, considering appropriate time horizons. Operational challenges, such as data management and execution costs, impact implementation feasibility for various investors. The economic rationale for factor timing hinges on market inefficiencies. Advances in machine learning and alternative data could enhance strategy efficacy, offering new insights and opportunities. Dynamic strategies introduce complexity, necessitating improved risk-adjusted returns to justify their use. Theoretical models often face significant implementation challenges. Robust statistical methods and suitable time horizons are crucial for evaluating factor timing strategies. Investor discipline is essential, especially during underperformance, to ensure successful implementation. Thank you for exploring this finance-driven case with SkilledMBA. The SkilledMBA Case Series offers advanced financial case studies, ideal for students and investment professionals, aiming to enhance their grasp of modern market challenges. For further insights, contact SkilledMBA via mobile at +91 87553 00795, email at support@skilledmba.com, or visit their website at https://skilledmba.com.